Welcome to LP Live Digital Dialogues. And starting today, VCCircle will connect live with a leading LP every week to give all our viewers a flavor of the opportunities and trends developing in the alternative investment space. These dialogues will then lead into the 12th edition of India's premier summit, VCCircle Limited Partners Summit 2021. It is scheduled to happen on 18th and 19th February 2021. So today's topic is risk-reward ratio trends in backing Indian GPs versus other markets. Now, I have with me Abhishek Paronigar, Director, Moravia Capital Investments, to discuss that and a lot more. Just to give you a brief about Moravia Capital, it's a global private equity fund of funds which backs private equity and venture capital funds. It recently made its debut LP investment in India. Let's hear more from Abhishek himself. So, Abhishek, if you could give us a brief about the journey of Moravia Capital globally and particularly in India, then we kind of kick off the conversation from here.
Sure. Good morning, first of all, and good morning to all our viewers who've taken out time on a busy weekday in the morning. So thanks a lot for joining us. And thanks to VCCircle for inviting me for this panel. Or for this discussion. It's always been a pleasure attending the VCCircle events. So Moravia Capital Investments, let me give you a brief about what we are doing. So essentially, Moravia Capital Investments is a global fund of funds, and we are looking at investing in venture capital and private equity funds. And essentially, we are building a well-diversified portfolio of private equity funds for our investors. Having said that, we have a global mandate, so we are looking at investments in the US, in Europe, and also in Asia, including India. That's broadly what we are doing. And in terms of strategy, we are pretty much open to all traditional private equity strategies. So that's venture capital, growth stage funds, buyouts, a little bit of co-investment and secondary funds as well. In terms of our journey, we started in 2017. And we've built a well-diversified and a good portfolio, I would say, over the past 3 years. So we've made a couple of investments in the US. We've made a few in Europe. And we've also invested in one fund in India last year. So that's broadly in terms of geography, we're kind of well-diversified, or at least I would believe we've done a good diversification across geographies. And in terms of strategy, we've been focused on the mid-market or the lower mid-market in most of these geographies. So we've invested in a couple of lower mid-market funds in the US. We've invested in some similar type of funds in Europe. And in India, we've invested in a growth stage fund, which focuses again on the SMEs or the mid-sized companies, so to say. So that's broadly what we've done. And having said that, we are really excited about the opportunity the private equity market offers in India. And we're looking forward to it.
Interesting. So you mentioned about your first investment in India and that you kind of sealed recently. So can you share with us what makes you so bullish about the country and what are the opportunities that you sort of see which are interesting from LP perspective?
Right. Yeah, I mean, so this thesis is very simple. It's the enormous growth that we're looking at, which India kind of offers. I mean, it's the fifth largest economy in the world, going to be the third largest in the next couple of years, one of the fastest growing large economies, $2.5 to $3 trillion of GDP already, going to double in the next couple of years, actually $2 to $3 trillion of opportunity or the market size, which is going to be offered in the next 5 to 7 years. And we want to be part of that. I mean, it's housing 1/6 of the world's population. Think like this. It's housing 1/6 of the world's population, about 17%. It's commanding over 3.3% of the world GDP. And you want to have an exposure to that market. You cannot ignore a market which is that large. When you're thinking from an international LP's point of view, this is something which has to be there in your portfolio. So we've made the beginning, we've made the first investment, and we look forward to it. And similarly, I mean, if you look at it, it's going to have the largest workforce by 2025. I mean, so many people going out to work, they are going to create GDP, they are going to create wealth, and you want to be part of that journey. So that's essentially the main reason, the growth that we are looking at. And the second reason I would say is the returns. I mean, that's essentially what all LPs are looking at. And for us, it's an international allocation, right? So we compare each opportunity with any other opportunity which is available worldwide. So if we are looking at it, we've compared and we've done our own analysis. And in the past, we've seen that broadly, the returns from the Asian markets are more or less in line with what Europe and US are generating over a long term. So if we see, we were looking at one of the studies done by Preqin, where they've compared median IRR of funds which are investing in these focused geographies by vintage. And pretty much in most of the vintages, the difference is not more than 2 or 3% in terms of IRRs. So sometimes US is better than Asia, sometimes Asia is better than US or Europe, and so on and so forth. And those numbers are on an increasing trend, I would say. So I would just like to mention some numbers from the Preqin study. So 2016 vintage funds, the net IRR of funds, of private equity funds, all strategies investing in the US was about 15%. For Europe, that number is 13%. And for Asian funds, that number is 14%. So we are just about 1 or 2 percentage points up or down. Again, these are median IRRs, but broadly within that range. And for 2017, the numbers get better. So US is 13.3, Europe is 9.5, and Asia is 16.8. So essentially, you need to have an exposure to an Asian market. And most of these, good number of these investments were in India. So this is a representative benchmark number, I would say. And and this is historic numbers, which gives us a good sense. And we have invested in a global co-investments fund, which is a well-renowned, well-established co-investment funds with deep entrenched relationships with GPs worldwide. And they are investing in all these three markets. And our investment, these are live numbers. So we have the numbers for Asia, which is 1.51x of our investment. This is a 2018 vintage fund. For US, the number is 1.21x. And for Europe, it is 1.13x. So Asia is doing far better than Europe and US. So you need to have an exposure to a market to balance your portfolio. That's simply the argument. And the third, that's a third point is diversification, which is what all LPs are looking at. So you need to have a balanced construction of portfolio. So I would say these are the key reasons broadly which made us invest in India.
Interesting. Can you also chart out the journey and evolution of private equity space in India, especially from an LP perspective? How have you seen the sort of ecosystem evolve over the years?
Right. So let's maybe take a step back into history. Maybe we start from let's call it pre-2005 era, which was pretty much when private equity in India was very nascent. I think that was in terms of risk reward. That's the topic for today. So in terms of risk reward, that was a very favorable risk reward ratio in terms of investing in India. Enormous growth from 2003 to 2007. Metals was in a super cycle, infrastructure, consumption, banking, everything was growing. All sectors were booming. Fantastic time to invest, and not many private equity funds in India at that moment. So a lot of good deals, very few chasers of those good deals. So fantastic valuations to invest. Those vintages have done really well. Then you have the 2006 to say the post-crash kind of era till 2009, 2010. The valuation that time was stretched. All international LPs pumped in a lot of money, 2005, 2006, and very few deals and a lot of capital chasing that, really high valuations. And what happened? The returns of those 4 or 5 vintages were really bad. And then you have 2010 onwards, which was a good time, a very difficult time to raise capital from the international market for these funds because all LPs had burned their fingers and they didn't want to return back to India. But all those who did made really good returns. 2010 onwards, private equity is done really well. And then if you see post demonetization or whatever, 2017, 18, 19, private equity has done really well. That was a good market. the ecosystem has matured, far matured than what it was. And the
Right.
returns are looking good. I mean, we'll still see. I mean, those investments are done. It's in harvest mode, but we'll see some of those good returns and performances coming out now.
Sure.
That's how I would put it. And of course, I mean, 2020 COVID is kind of exceptional. I'm not talking about that as of now, but it's all pre that. This is how the trend been. And
Mhm.
yeah.
But what are some of the concerns that kind of still bother LPs? I mean, if you can talk about the risk, because what I understand, I think exit has been an issue over the years. Do you think that kind of still bother LPs? What are some of the concerns that you can highlight that are still on the table, and kind of LPs look at those factors, and sort of that becomes a big factor to sort of whether to invest or not to invest in a particular country, especially in the context of India?
Yeah. I think that's a good question. I mean, of course, with rewards or with returns, there's always some risk associated, and it has to
Sure.
be a calculated call in terms of an investment. So let me probably talk about the top three. I mean, there are a list of concerns that people would have, and then the degree of each of the concerns would vary for each of the markets. But maybe for India, maybe let's talk about the top three concerns. The first one being currency devaluation. I mean, the INR returns of most funds, whatever, 2005 or 2007 and all those vintages were phenomenal. But the US dollar returns for international LPs was all eaten up because of Forex devaluation, the rupee devaluation. And again, I mean, that's not something the fund manager can do. That's not within their control. But as an LP, that's a concern that we're looking at, that even if the fund manager does really well, what do we get? I mean, if we are putting in our capital, we need the return that will kind of boost our portfolio. So that's
Mhm.
been the main concern for most international LPs, I would believe. But
Right.
what's interesting is, I mean, if they are looking at emerging markets, they need to look at India. And if you see the last 5 years, or maybe 2014 onwards, 2014 to 19, the currency devaluation for India has been about 12%. So it's negative 12%, which is
Right.
far more stable than the other emerging markets. So
Right.
Mexico, it's been minus 31%. Brazil has been minus 42%, and something like a Turkish lira has seen a minus 62%. So, I mean, you really can't invest in those markets and expect a dollar return. So from
Right.
that point, I think the Forex fluctuation or devaluation risk has kind of stabilized. It's not that large anymore. You kind of underwrite 2 to 2.5% depreciation each year. That should be fine. And the
Okay.
second most important concern, which you pointed out in your question, is the exits. So
Okay.
really, those funds which invested 2005 to 2007, the exits were really slow because of the crash, because they had invested at high valuations, and also the
Mhm.
markets were not that matured. I mean, what has happened is in the past 3 or 4 years, the markets have really matured, and we have a host of new buyers whom the portfolio companies can be sold. So if you look at some
Mhm.
exit numbers, 2017 to 2019, we've seen about $50 billion of exits. That's not small by any standards. That's phenomenal. I mean, if you see 2014, the exits were about 3.4 billion. And now we are clocking 20 million, about 50 billion in last 3 years, and more than 10 billion each year. So that concern is not valid anymore. I mean, or at least
Okay.
that's what I would like to believe. If this run continues, we are going to see more exits, more frequent exits, and faster exits. You don't need to hold the
Okay.
asset for 8 to 10 years. You can start
Mhm.
exiting once you've created value in 4 or 5 years.
Sure.
And the third concern, which we also have, and probably we've heard from other LPs as well, international LPs, that when they compare the Indian fund managers with international fund managers, they've not seen very active value creation from the fund manager's side in India. I mean, we
Right.
understand it's not a typical leverage buyout where you take whatever 100% control or close to 100% control and then you call all the shots. But still, there has to be some operational involvement and more than just cleaning up the financials and replacing the senior executives and so on. It has to go far beyond that. But
Okay.
what we've seen in the last 3 years, a lot of funds are doing that. There are more majority control transactions happening now in India, and most PE funds have started thinking on those lines and setting up their own operational advisors or advisory board, or setting up some playbook for value creation, so to say. So that's something which is on an improving trend, but we would like to see some more. I think these are the three top concerns, I would say, and more, I mean, it's on an improvement phase, I would say. So it's always better to start investing.
Understood that. And from Moravia perspective, what all sectors are you looking at? I mean, what all sectors look interesting to you and why? And where all do you see opportunities?
Right. Yeah, so I mean, as Moravia Capital Investments, we are not looking at sector-focused funds in India, but we are looking at typical sector-agnostic funds so that we kind of well diversified in terms of sector risks. But yeah, having said that, we are keen on a couple of sectors. This is in no particular order. Probably one of them is healthcare. Post-COVID, kind of that gets traction, but otherwise too, I mean, healthcare has tremendous potential in India. That's what we believe. I mean, if you just look at the numbers as stacked up against the developed markets or even other emerging markets, the number of hospital beds, the number of doctors available per 1 lakh inhabitants and so on. I mean, those numbers are really, really low as compared to other markets. And I mean, that's sad in a way. That we don't have the appropriate and requisite amount of healthcare infrastructure and facilities, but that also offers a good opportunity for growth. That's where it's going to grow. I mean, and that's where the capital is going to get allocated. And historically, we've seen low per capita spends on healthcare in markets like India, but that's improving. I mean, with rising income, we see more and more people spending on healthcare. We see more and more people spending on insurance, private insurance, which kind of gives a boost to all these sectors. So healthcare is there to stay for next couple of years. I mean, that's a big trend which we are banking on in terms of growth.
Got it.
Second sector which we like, I mean, is financial services. Some of these are large capital guzzling businesses, but that's again a good proxy to invest in emerging markets. I mean, the banking and the NBFCs and the MFIs really benefit from the GDP growth and the boom in each of the sectors. You don't get benefit just from one sector or two sectors. So that's a good proxy to invest in terms of the overall growth of the economy. So we like that space. Private insurance, wealth management, all these segments within financial services are booming, fintech and so on. Third theme that we are really liking is the consumption theme, the entire consumer driven. I mean, probably India will have about 400 million middle class inhabitants in the next couple of years. That's going to be larger than the US. I mean, it's already larger than the US. The middle class, of course, the middle class there in terms of per capita and in terms of per capita in India differ, but that really doesn't matter. I mean, as far as the PPP is high, when these middle class consumers will start consuming, the growth is going to be phenomenal in the next couple of years. I mean, just a simple example, if you look at it in terms of aspirations, most two-wheeler owners today will want to upgrade to a four-wheeler. I mean, that's an aspiration that they have. And if you look at the number of cars per 1,000 inhabitants in India, that's really low, anywhere between 30 to 50 cars per 1,000 inhabitants. And if you look at that number in Germany, it's about 561. And in the US, it's about 838 cars per 1,000. So essentially, every household in the US or in Germany already has a car. I mean, what more? If there is a slowdown, if there is a COVID or any other kind of slowdown, instead of replacing that car every 3 years, probably they'll replace it every 5 years or 6 years. They don't need to replace it now. Whereas in India, there's always an aspiration. The moment someone will have disposable income, the two-wheeler guy would want to buy a four-wheeler, and who doesn't have a two-wheeler will want to upgrade to, want to buy a two-wheeler. So there's enormous growth that's coming in. I mean, this is just one example. The point being, those 400 million middle-class consumers are going to consume, whether you have stimulus or not. The moment they have money, they're going to spend. So the consumption theme is what we are banking on. Then the last theme is the whole technology piece on the consumer side as well as on the enterprise side, which kind of excites us. I mean, we've seen phenomenal growth in this segment. We've seen about 10 unicorns last year and total 50 unicorns so far from India. That's the third largest in the world. I mean, anyone who wants to invest in tech needs to invest in India after US and China, because that's where the most unicorns are coming from.
Correct.
So that's what we are looking at as well.
So 3-4 sectors broadly.
3-4 broad themes, but yeah, as I said, we won't do a sector focused fund. We kind of wanting to diversify on that front. So we're looking at sector agnostic funds, broadly targeting these sectors.
But any scope for doing a direct transaction or maybe partnering with somebody on a deal-to-deal basis? Is that there on the cards?
Not really. So we can do co-investments, but we would not do a direct deal out of nowhere. I mean, we can do co-investments along with the fund in which we've already invested and we know that manager and we trust their capabilities. Then we will ride along with them, but not do a direct deal on our own. I mean, that's not what we are targeting.
Okay. And talking about the COVID situation, we know that it has impacted sectors and businesses across. But in terms of your strategy, has there been any tweaking in terms of your sector focus, strategy, allocation in the context of the whole pandemic and the COVID situation? Have you done that?
Yeah. I mean, COVID shook all of us. I mean, we were no exception. Okay. So we had to kind of reevaluate or reassess our strategy and see what we do next. So we started off with a portfolio construction plan, and we had achieved quite a bit of it before the pandemic hit. So by February, March, we had kind of broadly achieved, say, 60-70% of what we wanted to. And the rest of it, we were able to tweak. Initial 2 or 3 months, we kind of waited to see how the situation evolves. I mean, we were kind of busy getting a feedback from our existing fund managers on what's the situation with the existing investments and so on and so forth. But yeah, once kind of things were looking stable, we thought that we still don't know how long this will take. Maybe at that point, people were talking 2 months, 4 months, but it's gone on far longer than what people would have expected at the beginning. So keeping that in mind, we said we'll evaluate which sectors will benefit. But yeah, that would take time for clarity to emerge. So we said we'll focus on healthcare and technology because these two sectors definitely look to benefit from the crisis. And we said that the developed markets with the stimulus will come back faster than the emerging markets. So we did a couple of healthcare and technology focused funds in the US and Europe in the last 4 or 5 months post-COVID. But yeah, I mean, 2021 vaccines rolling out, most of the places, India numbers going down. I think developed markets are kind of, coping well with it, but emerging markets also coming back very soon. And we've seen that the way the stock market is behaving in India, I mean, it's really bounced back, and that's the case most of the places. So I think we are back to where we were in terms of our view on India at the beginning of 2020. And we think COVID is kind of past, or hopefully that's the case.
Okay, understood that. And also just last 2 questions, if you can share with us 3-4 things that you will focus on this calendar year or maybe the next few quarters in terms of your allocation, strategy, focus. What's going to be your outlook from a how the market will pan out, and also 3-4 things that you'll focus on this year?
Right. Yeah, so let me talk more about India. I mean, our specific plans for India. As I said, It's a global fund. Yeah, we leave out what we plan for the US and Europe. But for India, I mean, the plan is very simple. We've done one investment last year, and hopefully we would do one more this year. So we are building our pipeline for the same. I mean, last couple of months we were on hold. Probably we will take a little bit more time to kind of reevaluate and create our thesis to be able to pitch to our investment committee. But the plan is to build the pipeline for India and then make a commitment in the coming year.
Sure. Understood that. And also wanted to understand India is compared with different sort of emerging markets. It has its positives and negatives. Can you compare for all our viewers India with other South Asian markets, and where does it stand in terms of its advantages, and also if you can highlight some of the negatives that people can sort of factor in?
Yeah. That's a very good point. I mean, from an international point of view or from an international LP point of view, Southeast Asia is a big topic of discussion, and people do compare India, China, Southeast Asia, and so on. So Southeast Asia, we've also mapped the market and evaluated a lot of fund managers there. But our biggest concern or challenge has been that uh, the markets are not that deep or matured as yet. So if you look at individual markets, Vietnam is doing well. Someone will say Malaysia, Thailand is doing well, but each of those individual market is not large enough in terms of an opportunity. And also, I mean, if you invest in one country focused fund like Vietnam, the risk is too high in terms of the country risk, the currency risk, political risk, and so on. And when you dig in deeper into these markets, as I said, the private equity ecosystem is still not that developed as compared to the other markets. You don't find established fund managers. I mean, there are just a handful of good managers, and then you kind of wonder, do you want to take that risk, or you are better off taking that risk somewhere else where you are sure of getting the rewards or the returns? So that's,
Sure.
I think, the key issue in terms of a key concern from the LP point of view.
Understood. Interesting. I think that's more or less covered. I think, and then we are like bang on 10:30. So
Yeah.
thanks so much for your thoughts and perspective, and thanks so much for your time.
Thank you to everyone.
Thanks everybody. Thank you. Thanks everybody.
Bye.